Imagine for a second that you own a piece of property. But I want you to just wipe the traditional image of a landlord out of your mind for a moment.
Okay, I'm with you.
You are not dealing with a leaky faucet at 2 in the morning. You aren't arguing with a college student about a security deposit.
Definitely not chasing down a rent check.
You are definitely not chasing down a tenant for a late rent check because their freelance gig didn't pay out this month.
That sounds less like being a landlord and more like winning a very, very specific kind of lottery.
It does, doesn't it? But in this fantasy, your property, it isn't a duplex or a condo. It's a gleaming glass facade tower.
Okay.
And your tenants, they aren't individuals. They're Google, they're Amazon, they're Apple, Goldman Sachs, and JP Morgan.
So the tenants who never, ever bounce a check, that is the dream.
That is the absolute dream. They sign 10-year leases, they spend millions of their own dollars fixing up the place to make it look like a spaceship, and every single month, like clockwork, they wire you a massive amount of rent.
Okay, you've sold me on the fantasy. What's the reality?
Exactly. This is the specific business model we're going to unpack today. We're talking about what I'm calling the ultimate landlord fantasy. And specifically, we're looking at how to do this in India, which is rapidly becoming the back office and, increasingly the front office for the entire world.
You're talking about Knowledge Realty Trust or KRT?
Precisely, KRT. Now, before we dive into the nitty-gritty, I want to set the mission for this deep dive. We are not just looking at stock charts today. We aren't looking for a quick trade. We're putting on our retirement planning hats. We really want to see if KRT can function as a pension replacement.
That's a big claim. A pension replacement implies safety, consistency, and real longevity.
It does. The question we're trying to answer is this. Can this be a compounding income machine that you buy today, ignore for 15 or even 30 years, and then wake up to find it funding your life?
Can you actually retire on the rent paid by Google? That's the core question.
That is the question. And to answer that, we have gone through a massive stack of sources. We have the IPO notes from when they listed back in August 2025. We've got the brand new Q3 FY26 earnings transcripts from, just last week?
Yeah, fresh off the press. And we've also got some pretty complex tax guys and their detailed investor presentations. It's a lot of material.
And the vibe we're going for, two smart friends figuring out how to, maybe quit their jobs in 15 years.
Sounds good to me.
So let's start at the very top, KRT. It's a real estate investment trust, a REIT. But it's not just any REIT, is it?
No, it's a behemoth. I mean, to put it into perspective, KRT is India's largest office REIT by gross asset value, which is sitting at over 62,000 crore.
62,000 crore. Just let that number sink in for a second.
It's huge.
Yeah.
But what really makes it stand out, I think, is the pedigree. It's co-sponsored by the global giant Blackstone and the Sattva Group.
Blackstone is a name that even, casual observers are going to recognize.
Oh, absolutely. They're arguably the biggest, most sophisticated real estate owner in the world. When Blackstone puts their stamp on a REIT, it brings a level of governance, a global network for tenants, and crucially, access to capital that is just very, very hard to replicate.
And Sattva.
And then you have Sattva, which is a massive, highly respected developer, particularly in South India. So you've got this combination of global financial muscle and deep local execution expertise. Together, they've built a portfolio that functions less like a collection of buildings and, more like a collection of small cities.
Okay, I like that framing. So let's get into section 1. What is Knowledge Realty Trust? Because when I hear office building, I admit I still have a bit of PTSD. I think of, gray carpets, flickering fluorescent lights.
Cubicles that smell like old coffee.
And just a general sense of sadness.
Yeah, and that's the old world. That's what we would call grade B or maybe grade C real estate.
Yeah.
KRT operates in a completely different stratosphere. We should really be calling their properties office malls or grade A workspaces.
Office malls? That implies I might actually want to go there on a weekend.
Well, maybe not on a weekend, but you certainly wouldn't mind being there on a Tuesday. I mean, think about it. These are not just concrete blocks where you go to type on a computer. They are genuine ecosystems.
Okay, unpack that. What does an ecosystem look like in this context?
If you look at their flagship assets, like Satya Knowledge City in Hyderabad or 1BKC in Mumbai, they are just packed with amenities. We are talking food courts with dozens of options. Not a sad little vending machine, but actual good restaurants.
You're not stuck eating the same sandwich every day.
Exactly. And then there are sports facilities like cricket pitches and tennis courts. There are on-site medical clinics, breakout zones, and vast green spaces. It's a whole campus.
So it's a place where you can get your teeth cleaned, play a match of cricket, have a gourmet lunch, and then maybe write some code, all without leaving the gate.
That's precisely the goal. And it works. This focus on placemaking, that's the industry term for it, is why they have such incredible tenant retention.
Okay, so how big is this portfolio again?
It's 30 assets spread across 6 major cities, with a really heavy concentration in what I call the tech triangle of Bengaluru, Hyderabad, and Mumbai.
Right, where the action is. And the tenants. We dropped some big names earlier, but let's just look at that list again. It's pretty impressive.
It really is. It's a who's who of the Fortune 500. You've got JP Morgan, ServiceNow, AMD, Apple, Cisco. I mean, the list goes on. In fact, Fortune 500 companies make up a huge chunk of their total rental income.
Now, this brings us to an acronym that keeps popping up in all the documents, GCC, Global Capability Centers. I feel like 5 years ago, we just called this outsourcing or maybe call centers.
And that is a misconception we absolutely need to clear up immediately because it is central to the entire KRT investment thesis.
Okay, so educate me. What's the difference?
If you think GCC means a room full of people answering phones and resetting passwords, you are missing the entire story. That might have been true 20 years ago. A GCC today is no longer just a call center. These have evolved into high-value R&D hubs, engineering centers, and what they call transformation hubs.
Give me a concrete example. What does that mean in practice?
Okay, look at the semiconductor companies or the global banks that are renting these massive spaces from KRT. They are not just processing paperwork. They're writing the code for the next generation of mobile banking apps. They are designing the fundamental architecture for the next AI chip.
So core intellectual property is being created in these buildings.
Exactly. The source material points out that India now has a 58% market share in global outsourcing. KRT is essentially the landlord for the world's innovation labs.
And why does that matter for me, the investor? Why do I care if they're writing code or just answering phones in there?
Stickiness. That is the magic word in real estate. It all comes back to stickiness.
Explain.
When a company like Apple or Google sets up a GCC, they invest a fortune in what's called fit-outs. They rip up the floors to install server-grade cooling and redundant power supplies. They put in high-tech biometric security systems. They import custom furniture. They might spend tens of millions of dollars just preparing the space before a single employee walks in.
So they're not going to just pack up and move across the street to save 5 rupees on rent.
Never. The switching costs are absolutely massive. Once they move in, they are geographically and financially stuck in a good way for the landlord. This leads to a tenant retention rate of over 61%. They come, they invest, and they stay for the long haul.
Okay, so just to recap, we've established they own these fancy buildings, these office malls, and they're filled with rich, sticky tenants who are doing incredibly high-value work.
That's a business model in a nutshell.
But let's get to the now numbers. Section 2, current performance. We're recording this in February 2026, and they just dropped their Q3 FY26 numbers. So how are they doing today?
The numbers are very robust. Revenue is up 21% year over year. Net operating income, or NOI, is up 19% year over year.
Wait, hold on. 21% revenue growth, that's double-digit growth. That is not the boring, stagnant utility company kind of growth I usually associate with just collecting rent.
No, it's growth at a massive scale. But let's talk about the number that really matters to the income investor, the DPU, or distribution per unit.
This is the dividend equivalent for a REIT, right? The actual cash that hits my account.
Correct. For Q3 FY26, they declared a distribution of 1.57 rupees per unit.
1 rupee and 57 paise.
Yep. Which adds up to a total payout of over 6,953 million rupees just for this one quarter.
So if I'm doing some quick back-of-the-envelope math here, 1.57 a quarter. Obviously, quarters can vary a bit based on cash flow, but if we try to annualize that.
The company's own guidance hovers around 6.20 rupees per unit annually, so about 6 rupees and 20 paise.
Okay, 620. And the unit is trading at around 126 rupees as we speak.
Right.
So if you do the math, 6.20 divided by 126, that gives you a yield of, it's a little under 5%, actually. Oh, wait, no, it's closer to 6. My math is off.
It's in that range. The sources explicitly mention a distribution yield of 6 to 6.5%.
Okay, so 6 to 6.5%. I have to play the skeptic here for a minute.
Please do.
A 6% yield. In a world where I can put my money in a fixed deposit, an FD, and get 7 maybe even 7.5% with zero risk. Why would I take the risk of the stock market for a lower headline yield?
That is the classic and I would say fundamental mistake people make when they first evaluate REITs. You are comparing a dead instrument to a living one.
A dead instrument, what do you mean?
An FD is stagnant. It's a fixed contract. You put in 100 rupees, you get your 7% interest, and at the end of the term, you get your 100 rupees back. But in that time, inflation has likely eaten away at the purchasing power of that principal. Your 100 rupees buys less than it did before.
Okay, fair point. And KRT?
KRT is a living, breathing asset. The sources mention a total return target of 12 to 15%.
Okay, now you have my attention. How do we get from a 6% yield to a 15% total return? Where does that extra 9% come from?
It comes from growth. It's a two-part return. You get the 6% in cash, wired directly to your bank account every quarter. That's your income. But you also get capital appreciation. The value of the buildings goes up, and crucially, the rent itself goes up.
Which transitions us perfectly to Section 3, the growth engine. How does the rent go up? Because if my DPU of 620 stays at 620 forever, inflation is going to eat me alive, just like you said with the FD.
Right. And a landlord has two main ways to make more money. It's pretty simple, really. Method 1, you charge your current tenants more over time. Method 2, you buy more buildings.
Okay, let's look at method 1 first, the organic growth. How do they charge tenants more?
This is one of the most beautiful parts of the commercial real estate model in India. The leases are structured very differently from residential ones. In a residential lease, you might have to negotiate every year, and it's a hassle.
A huge hassle.
Commercial leases, on the other hand, typically have a contractual rent escalation clause. The standard is 15% every 3 years.
Wait, let me just pause you there because that's a critical point. 15% every 3 years.
Guaranteed. It is written into the contract. It's legally binding.
Imagine if your salary had that clause. Hey, boss, just checking the calendar. It's been 3 years. Yep, time for my automatic 15% raise.
It's an incredibly powerful compounder. It's the engine that ensures the rental income consistently beats inflation over the long term. But KRT is actually getting even smarter with this strategy.
How so?
In some of their key markets, specifically Mumbai, which makes up 32% of their portfolio value, they're moving away from the 3-year bump and toward annual escalations.
Why change it if the 15% every 3 years model works so well?
It smooths out the income stream. Instead of waiting 3 years for one big jump, which creates what analysts call lumpiness in the earnings, you get a steady, predictable bump every single year.
Which is great for retirees who want a steady, predictable income.
Exactly. It makes the cash flow much more reliable.
Okay, so those are the scheduled raises that are baked into the contracts. But what about this mark-to-market or MTM potential I keep reading about? The sources say KRT has a 20 to 22% MTM potential. That sounds like jargon. Unpack it for me.
It's simpler than it sounds. Think of it this way. Suppose you leased an apartment to a tenant 5 years ago for 50,000 rupees a month.
Okay.
Today, the going market rate for that exact same apartment is 70,000 rupees. But your tenant is still locked in, paying the old rate of 50,000 until their lease expires.
Right. I'm leaving 20,000 rupees a month on the table.
That 20,000 rupees is the mark-to-market opportunity. It's the difference between what tenants are paying under old contracts and what the current market would pay today. KRT has leases expiring continuously. Their weighted average lease expiry, or WALE, is about 8.4 years.
So as those old lower rent leases expire,
They can immediately release that same exact space at today's market rates, which the company says are, on average, 20 to 22% higher.
so they don't even need to find new tenants or build a single new building to get a 20% growth kicker. They just need to wait for the calendar to flip and the old leases to expire.
That's the power of it. And we have concrete proof this is working. Look at their premium asset in Mumbai, 1BKC. They recently released a space and achieved record rentals of 430 rupees per square foot.
And how did that compare to the old rent?
That was a 17% positive spread over the previous rent for that space. They effectively gave themselves a massive raise just by signing a new piece of paper with a new tenant.
Okay, that's the organic side. It's powerful. Now, what about method 2, buying more buildings, the inorganic growth?
Right. This is where the strength of their balance sheet comes into play. KRT has a very, very low loan-to-value ratio, or LTV, of just 18%.
Is that low? What's the context for that number?
It is incredibly low. The regulatory cap for REITs in India is 49%. So they could legally have more than double the debt they currently have.
And what's a more typical number? What's the comfort zone?
The general comfort zone for most institutional investors is somewhere in the 30 to 35% range. KRT is sitting way down at 18%.
So they have a massive credit card with a nearly zero balance.
That's a great way to put it. They have significant headroom, a huge war chest, to go out and borrow money to buy more office parks without diluting the current shareholders by issuing new stock.
And they can do that profitably.
Yes, because they can borrow at, say, 7 or 8% and buy a fully leased building that generates a 9 or 10% return. That difference, that positive spread, drops directly to the bottom line and increases the DPU for everyone.
And they have a pipeline for acquisitions, right? They don't have to go hunting on the open market.
Precisely. Their sponsor, the Sattva Group, has millions of square feet of grade A office space under development. KRT has the right of first offer on these properties, so they have a built-in supply of future growth.
The mechanism and the supply, it's all there.
Exactly.
Okay, so we have the machine, we have the rent coming in, we have the built-in escalations, we have the MTM opportunity, and we have the borrowing power to expand. Now I want to do some time travel.
My favorite part.
Section 4, the 15 and 30-year horizon. This is the heart of the pension replacement idea. Let's play this out. I buy KRT units today. I close my eyes. I wake up in 2041. That's 15 years from now. What has happened to my investment?
Okay, let's walk through the math of that 15% escalation every 3 years. Over a 15-year period, that represents 5 full cycles of 15% bumps.
5 cycles.
If you just compound that growth, the rent per square foot, and therefore likely your distribution per unit, has essentially doubled. And that's just from the existing contracts, not assuming anything else.
So my 6 rupees and 20 pays payout has become roughly 12 or 13 rupees.
Likely even more, because that simple calculation doesn't even account for the big jumps from the mark-to-market potential we just discussed, or the new buildings they bought and added to the portfolio.
But let's just stick to the most conservative organic growth for a second.
Okay.
You are now earning a double-digit yield on your original cost. If you paid 126 rupees for your unit back in 2026, and you're now getting 13 rupees a year in cash, your personal yield, your yield on cost, is over 10%.
And what about the unit price itself, the value of my principal?
Well, commercial real estate is valued based on the income it generates. If the dividend, the DPU, has doubled, the stock price should theoretically have doubled as well, just to keep the headline yield percentage steady for new investors.
So you have growth in the monthly paycheck and growth in the principal.
It's that dual engine growth. The source material mentions that you can expect something like 5% net asset value growth per year purely from these contractual escalations alone. Wow. Okay, now let's go extreme. The 30-year view. I wake up in 2056, I'm old, I need this money to pay for my life. What does it look like?
This is where it really transforms into a true pension replacement. In 30 years, we're not talking about 5 cycles of escalations. We're talking about 10 full cycles. The compounding effect becomes immense.
And on top of that,
you have the inorganic growth multiplier. Over 30 years, it's highly probable that they would have used their low-cost debt capacity to maybe double or even triple the size of the entire portfolio. You own a slice of a much, much bigger pie.
But this assumes a lot, doesn't it? This is a very rosy picture.
It does. It fundamentally assumes the India story holds up. It relies on India remaining the office to the world.
Which, to be fair, all the data seems to support. The sources project the number of GCCs in India to go from 1,700 today to over 2,100 by just FY28. That's a massive ongoing trend.
Right. And if that trend continues for 30 years, if India continues to produce the engineering and financial talent the world needs, then the 30-year holder isn't getting a 6% yield. Their yield on cost, the cash they get annually versus the money they put in way back in 2026, could easily surpass 15% or even 20% annually.
That is the compounding rental income narrative in action. It brings to mind that old quote, "Compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it."
Exactly. This is a vehicle for earning it. It's slow, it's boring, and it's incredibly powerful.
But wait, we cannot talk about income in India without talking about the taxman. Section 5, taxation. And I have to say, this is where things usually get complicated. REIT taxation can make my head spin.
It is complex, but for KRT, at least right now, it's actually a surprisingly good story.
Yeah.
We need to use what I call the bucket strategy to understand it.
Okay, lay it out for me. Taxation for dummies. When I get that 1 rupee and 57 pays payout, it's not just one lump sum in the eyes of the tax department, is it?
No, it's actually a mix of 3 different things, and each is taxed differently.
Okay, bucket number 1.
Bucket number 1 is dividends. In the most recent quarter, Q3 FY26, a full 69% of the distribution was classified as a dividend.
And is that taxable? Dividend income usually is.
Here's the crucial nuance. Because KRT's underlying SPVs, the special purpose vehicles that actually hold the individual buildings, have not opted for the new concessional tax regime, this specific dividend is tax-exempt for the unit holder.
Wait, say that again? Tax-exempt, as in completely zero tax.
For the resident Indian investor, yes. You pay 0 tax on that 69% of the money that hits your account.
That is huge. That alone makes it better than an FD from a tax perspective. Okay, what's in bucket number 2?
Bucket 2 is classified as repayment of debt. This made up 23% of the distribution this quarter.
And the tax on this piece.
This piece is tax deferred. You pay 0 tax on it right now. However, and this is important, you have to deduct this amount from your original purchase price, your cost of acquisition.
Give me an example of how that works.
Okay, say you bought 1 unit at 100 rupees. This quarter, you get 2 rupees as repayment of debt. You pay no tax on that 2 rupees today. But for future tax calculations, the government now considers your purchase price to be 98 rupees.
Ah, so when I eventually sell the stock in 30 years, my capital gains will look slightly bigger on paper because my starting cost is lower.
Exactly. You will pay a bit more tax way down the line, but you get to keep the cash now and let it compound for decades. It's essentially an interest-free loan from the government.
I love that. An interest-free loan from the tax man. And what's the last bucket? Bucket number 3?
Bucket 3 is interest. This was the smallest component, only 8% of the total distribution.
And this one, let me guess, this is the bad news.
This is the bad news. This portion is taxed at your marginal slab rate. So if you're in the 30% tax bracket, you'll pay 30% tax on this tiny 8% sliver of your income.
Okay, so let me summarize to make sure I've got this straight. 69% of the income is completely tax-free. 23% is tax-deferred, meaning I pay nothing now. Only a tiny 8% is fully taxed today.
Exactly, which means over 90% of the cash you received in Q3 was effectively tax-free or tax-deferred in the present moment.
Now let's compare that again to the fixed deposit. With an FD, 100% of the interest is taxed at your slab rate.
Right, so if you're in the 30% tax bracket, a 7% FD really only gives you a post-tax return of 4.9% in your pocket. A 6% REIT yield that is mostly tax-free puts significantly more actual cash in your hand.
That is a massive advantage that I feel isn't highlighted enough when people talk about these instruments.
It's a game changer for income investors.
But, we have to be responsible here. It cannot be all sunshine and tax-free dividends. Section 6, risk versus reward. What could go wrong?
The biggest bogeyman for office real estate over the last few years has, of course, been work from home.
Right. The narrative is offices are dead. Everyone is working from their couch in their pajamas. Why would any company rent a massive, expensive office anymore?
It's a very kitschy headline, and it certainly felt true in 2021. But the data on the ground in India today completely refutes it. India's office leasing hit an all-time high in calendar year 2024. Over 80 million square feet was leased.
An all-time high. So companies are leasing more space, not less.
More than ever before. The management in their earnings call argues this is a structural demand, not a cyclical one. As we discussed, these GCCs need collaborative spaces for R&D. You can code a basic website from home, but if you're designing a jet engine or a complex banking algorithm, you need teams of engineers in a room with whiteboards and highly secure servers.
And a lot of global companies are now mandating return to office anyway.
Correct. The GCC boom is structurally outpacing the work-from-home drag in the Indian context.
Okay, so let's say the demand is there. What about risk number 2? Geography concentration.
This is a valid one. 95% of KRT's value is concentrated in just 3 cities: Bengaluru, Hyderabad, and Mumbai.
I mean, those are the right 3 cities to be in, but what if Bengaluru has another major water crisis? Or the traffic gridlock in one of these cities gets so bad that companies just stop expanding there?
It's a real risk. A major infrastructure failure or a negative policy change in one of these cities could disproportionately hurt the portfolio. Now, to be fair, KRT is the most geographically diverse REIT in India compared to its peers. Some of its competitors are 100% in Bengaluru, for example, but the concentration is still a factor to watch.
So if one city suffers, the REIT suffers. Makes sense. What about execution risk? You mentioned they have a big development pipeline.
Yeah, they have 8 million square feet of future development planned. Construction is hard. It's complex. Delays happen. Cost overruns happen. If the price of cement or steel spikes or if permits get stuck in bureaucracy, that inorganic growth we were banking on gets pushed back.
Fair points. But on the flip side, there's also a reward driver we haven't touched on yet, something the reports call the nano GCC.
Yes, this is a fascinating new trend. We usually think of GCCs as these massive, sprawling campuses with 5,000 employees.
Right, like a small town.
But there's a new trend emerging of nano GCCs. These are much smaller, highly specialized centers focusing on niche areas like AI research or semiconductor design. Maybe it's just 50 or 100 super specialized engineers.
And they probably don't need a huge campus on the outskirts of the city.
No, exactly. They want high-end city center offices. They want to be where the action is, close to restaurants and amenities, to attract the very best talent. KRT has a uniquely positioned portfolio because they have the massive parks from Amazon, but they also have the premium city center assets like 1BKC for these nano GCCs.
So they can capture the whole spectrum of demand. It's like having both the big box hypermarket and the luxury boutique in the same retail portfolio.
That's a perfect analogy. It diversifies their tenant base and their asset type even further.
All right, we've covered the business model, the current numbers, the growth engines, the very attractive tax breaks, and the key risks. Let's bring it all home. The outro. What is the final verdict here?
I think KRT is essentially a bet on two things. First, it's a play on India's continued service sector dominance. And second, it's a bet on Blackstone's global management expertise.
You're getting a starting yield of around 6 to 7% that grows over time, with that incredible tax efficiency we talked about.
Exactly. It's what you might call a defensive asset, but one with significant built-in growth characteristics. It's not going to double in price overnight like some speculative tech stock or a crypto coin.
No, but it's also incredibly unlikely to go to zero overnight either. It feels more like a wealth preservation and accumulation tool.
That's the right way to think about it.
You know, I like to frame it this way. We often talk about investing in tech stocks. Buy Google, buy Apple. But investing directly in tech can be incredibly volatile, and you have to pick the winners. In a gold rush, sometimes it's better to be the one selling the shovels.
Or in this case, the one renting the office space where all the code is being written.
Exactly. Are you ready to be Google's landlord? That is the fundamental question that an investment in KRT poses to you.
And, of course, a very important reminder. Nothing we've said today constitutes financial advice. We're just two people who enjoy reading earnings transcripts and investor presentations, so you don't have to.
Absolutely. Always do your own research. Check out the sources for yourself. Look at the numbers. And hey, maybe take a walk through an office park next time you're in Bengaluru or Hyderabad. You might just be looking at your future retirement fund. Thanks for diving in with us.
My pleasure. See you next time.